Good afternoon and welcome to the latest Yellowstone Advisory and ShareSoc webinar with James Collins, Director of Investor Relations and Financial Planning at Sainsbury's. I'd like to now hand over to James to start the presentation.
Thank you very much, Alex. Joe, just checking that, that everything's up and running. Yep, all looking good, so I can see the slides. Thank you for joining us this afternoon. I'm going to run through a brief number of slides, just giving a little bit of background on Sainsbury's, a little bit of coverage of the results that we published at the end of April, what we said about the outlook, what we said about cash flow and where we are in terms of dividends from shareholders and what we're signalling there. So I'll run through those and then aim to leave plenty of time for questions and answers at the end. So moving on, please, the first slide. So this gives a bit of an overview of Sainsbury's. So if you look at the chart on the right-hand side first, that shows you how our sales split down. So more than 70% of our sales on an ex-fuel basis come from grocery. Through our stores, so supermarkets, convenience stores, and online. Fuel's a big part of our business, obviously with petrol stations predominantly attached to our supermarkets, and then general merchandise, both through Sainsbury's stores, but the bigger part of our general merchandise business is Argos. So that's the sales split, and clothing, which is a relatively small part of our business, but a part which has just moved over into 1 billion of sales for the first time. Looking at the left-hand part of the chart, so that shows you how we split down. So around about 600 supermarkets, 800 local stores, so convenience stores, both in city centres, but also in kind of semi-urban locations close to where people live. Online, a big part of our business. So last year, I think it was 17% of our grocery sales, now settling down to around about 15%. It peaked at around about 20% during the pandemic. And then convenience sales, you can see of those overall grocery sales, convenience accounting for kind of pushing towards 15%. Argos, we have around about 1,000 points of presence. The Argos estate is changing, where we are closing a large number of standalone stores and moving those Argos stores inside Sainsbury's. It's a very big driver of cost savings and actually of convenience for customers, because it's easier to pick up orders in a Sainsbury's store with longer opening hours and free parking. And that reflects the fact that around about 80% of sales start online. So even despite the fact around about 60% of sales are picked up in store, the vast majority of those are sales which people have ordered online beforehand to pick up in store. Nectar is our loyalty program, around about 18 million members, 9.3 million digital collectors, so importantly using the app. It's really important across Sainsbury's and Argos in terms of delivering value for customers, but also an increasing driver of the way that we can generate revenue and offer targeted services to suppliers. And then the other brands within the business, Sainsbury's Bank, a useful recovery that we've had in profitability over the last year post-pandemic, and we're anticipating another improvement in profitability this year, and on the way to delivering far better returns in the bank. Our clothing business and Habitat, which is a brand which we're putting more and more emphasis on in our stores. Hopefully well known to you, but it is a very well-known brand featuring furniture and homewares. So that's the overall shape of the group. Looking at the financial performance of the last year, you'll see on a number of occasions here that we're showing retail sales growth, we're showing year-on-year sales growth, but also year on 2 years. And this is because obviously the pandemic has changed things pretty significantly and changed a lot of the comparatives. So if you look at grocery, the biggest part of our business, sales were broadly flat year on year last year. But versus the pre-pandemic year, that means we were up around about 8%. So clearly sustaining a large amount of the sales that have been driven more towards Sainsbury's stores and people who are able to offer online, but B, reflecting a higher grocery spend in home as opposed to out of home. Now, we are in a normalisation period where as people spend more time eating out of home, eating in offices, eating in restaurants, you're seeing some normalisation of that, but we do think that some of that will sustain. General merchandise is a complicated picture, so sales down on a year-on-year basis and down on 2 years. The primary driver of this, so year-on-year, that reflects the fact that we saw some very, very strong sales during periods of lockdown, when Argos was one of the few retailers that was open and able to trade, and clearly has a sweet spot in the kind of categories where people were spending money within the home. But also on a 2-year basis, you've seen reduced sales, and that reflects the fact that we have been focused on Argos being a more profitable business, so reducing the amount of promotional participation, and reducing some of the exposure to categories which were earning us less money. So we've tightened the scope of the general merchandise business, made it a much more sustainably profitable business. And then clothing, a strong bounce back against some periods last year where not much clothing sales were being done in stores, when people were just focused on getting in and out and doing their food shopping, but also up on a year on 2-year basis. Pretty pleasing, actually, given that we have again reduced promotional participation in clothing. So again, a more sustained, profitable business. So overall, excuse me, that meant for us that sales were down year on year, up on a 2-year basis, on an ex-fuel basis. If you then add in a big bounce back in fuel sales, that means overall last year our sales were up. So that's a complicated picture on sales, but that's what contributed last year. So moving forward, what did that mean for profitability? So up 7% year on year, year on 2 years, so versus the pre-pandemic levels on an operating profit basis in the retail business, and a big bounce back from last year where we were heavily hit by COVID costs. But as I say, on a pre-pandemic basis, up year on year. Financial services, you've seen a big rebound. Last year, the profitability was impacted by needing to provide for pandemic risks, and versus that last year, you've seen a normalisation. And if you then take into account reduced interest costs as we've been paying down debt, then that means that versus the pre-pandemic level, profits were 25% higher year on year, at 730 million. We did call out that within that 730 million, there was a tailwind, continued tailwind from stronger than anticipated grocery sales because of lasting pandemic effects. So we do expect a reasonable amount of that to normalise this year. So we said that might have been up to around about 100 million. But even then, if you choose to take that as 630 million, then versus that 586 pre-pandemic base, still a useful increase. Statutory profits higher than that, just reflecting the fact that we had some one-off benefits from some legal awards that we were made, in particular where we had a dispute with Visa and MasterCard, and we won those cases and got some income from those, plus also making some profit on some property ventures. So that's the headline numbers. Looking at what that means for cash through to dividends, we have said consistently that we expect to generate retail free cash flow at least £500 million on average. Excuse me. Over the last 3 years, we delivered that just over 600 million. Slightly lower this year, reflecting the reversal of some big benefits we had last year on working capital, which you can see in the following block. You can see net debt. We now have pretty much no net debt on an ex-lease basis, so just 141 million of net debt, and that reflects the success we've had in kind of deleveraging the business. EPS, very good result last year, and that fed through to a dividend per share which I think is the highest dividend we've paid for around about 6 years. Moving on. And this is a really important story in terms of how we think that we can consistently deliver for shareholders. So if you look over the last 5 years, you can see we've generated cash flow as a business of 2.8 billion, and that's been split into debt repayment and dividends. So, so you can see that the bigger part of that over the last 5 years has gone to debt repayment. On a dividend payout ratio, we've paid, on a profit basis, we've paid an average of about 52% of profit out to shareholders. So a pretty consistent dividend, but one that hasn't necessarily been growing. What we've said now is that clearly we're in a position where we don't really need to pay down any more debt. So therefore we will have more cash available to return in the form of dividends. So in the first instance, we laid out a capital allocation framework, and we said in the first instance that we are increasing our payout ratio from that to around about 50% to around about 60% from next year. And overall, what we've said is that we aim for a leverage ratio, so net debt to EBITDA ratio of 2.4 to 2.8 times. We're currently at 3.1. So as we see a bit more reduction in leverage over the next 2 to 3 years, taking in some technical factors, that means we'll be in a position where, in addition to continuing to pay a good regular dividend, we think we will then, in a couple of years' time, be in a position where we can look at other forms of cash return to shareholders. Excuse me. This is how we laid out the capital allocation framework. I don't think there's any great deal of point in spending much time on this. So priorities: investing in the business. We want to be investment grade to give us flexibility to see us through tough times, or in the event that that there is something interesting that we might want to take advantage of. So we think it's important to be investment grade so that we could raise debt if we needed to. Hence the target leverage ratio. So that's the number 2 priority. That determines how we the shape of our balance sheet. From that, we focus on really strong dividends for shareholders. And then once we've done that and we potentially have more cash available, as I said earlier, we might be able to return more cash to shareholders in time. So that's a quick run through where we are numbers wise. I'll just take you through the highlights of the last financial year, and a little bit of how we're feeling about the year ahead in particular. So these are the priorities that we set out in November 2020. Food first being, the really important one. We acknowledged that we were not sufficiently focused on the core business. And that's been the real focus, is putting more emphasis on value and innovation in the core business, and finding the ways to pay for that. So firstly, by cost savings, where we're developing a very strong program, but also making sure that what we call the brands that deliver, so i.e. the other brands, so the bank to Argos, are all also helping contribute to that. So as they've become more profitable, they've meant that we've been able to put more investment back into the food business. That's helped us drive volume market share and deliver better value for customers. And Save to Invest is the program of cost savings that also helps support that. That's the key priorities. Underpinning that, connected to customers, Nectar is a key part of this, where we obviously have very good knowledge of customers and how they behave across all of our brands, and plan for better, making sure that we do this with some kind of key goals in mind in terms of how we perform for improving the outcomes for the planet, for consumers in terms of health, and in terms of all of our suppliers and the communities that we operate in. So that's the key priorities. Excuse me. At the same time, we set out 8 key metrics, and we've been consistently telling the market how we're doing versus those and reporting on a consistent basis. So running through those quickly, grocery market share performance was really important. This had not been strong prior to the last couple of years. If you look now, this is the volume growth that we've delivered over the last 2 financial years relative to the rest of the market. So you can see we're marginally behind the market itself because the discounters continue to add new space and take share. But you can see that we were ahead of the rest of the big 4 over those 2 years. In part, that reflects customer satisfaction. So you can see that we have maintained the lead versus our competitors. We've marked ourselves orange here. We do think that that's a lead that we would look to extend again. And we also think that we can do better on online. This chart here reflects supermarkets. Colleague engagement. If our colleagues are happy, then they're generally delivering better customer service. And on that point, we're showing good metrics. Excuse me. And then on plan for better. On those considerations, again, marks ourselves orange. We've made some really good progress on carbon within our own business and on food waste within our own business. We've still got work to do on scope 3 and particularly on plastic. We have a long way to go in order to meet some pretty stretching targets that we have. So those are the first 4 metrics, excuse me, which are largely operational. On a financial basis, underlying profit before tax growth. So obviously good in terms of what we've delivered over the last couple of years. Key to that is reducing our cost base. So we targeted 3-year reduction of 200 basis points in SG&A to sales. In year 1, we've delivered 83 basis points. This year, we think we will make progress, not as much, principally because cost inflation is running very, very high. So that's a big challenge to offset that this year, but we think we will make progress. And we're on track for the 200 basis points over 3 years. Retail free cash flow, we've already talked about. And the combination of those and the capital discipline means that we are improving our returns. So against all those metrics, showing pretty good progress. A long way still to go on a 3-year program. We're 1 year in, but clearly making good headway. Excuse me. And again, looking at volume market share. So this goes just a little bit more detail, looking on a year on 2-year basis and also on a year-on-year basis. And what we're really pleased to show here is, firstly, that on a year on 2-year basis, we are, as I said earlier, broadly in line with the market. But again, significantly ahead of our competitors, both on a 1-year and 2-year basis. And you can see the breakdown there where the market is heavily influenced by Aldi and Lidl adding more space. So that's that metric in just a little bit more detail. Customer satisfaction. The supermarket chart you saw earlier on. The interesting shape of the chart there is the kind of the big reversal in Q2. So for us, that was the summer. That was when the whole industry had availability challenges. And I think it's fair to say that our customers expect better of us than we were able to deliver in terms of availability over that period. So we have seen some drop down in metrics. Availability is improved for us and for the whole of the industry right now, and so we would hope to see that lead that we have versus our competitors start to open up again. On online, again, availability has been a real challenge. So you can see the same dip down in Q2. And a lot of this, just to be clear on availability, is to do with various issues that suppliers have had on availability of workers, availability of distribution drivers, and some kind of key challenges in the supply chain around carbon dioxide, and a number of things which are unintended consequences either of Brexit, of late, some challenges due to the situation in Ukraine. And then a number also relating to the pandemic more widely. But again, on online, that's somewhere where we're really focused. It is important because probably more than in supermarkets, customers are able to choose very clearly who they shop online with. We are determined that we will get back on top in terms of the customer satisfaction. Value. So I talked earlier on about the food first focus of the business. We acknowledged, again, 18 months ago that we were not where we needed to be on price. And we've been really concentrating very hard on showing up better for customers. So firstly, giving reassurance, so on price lock, where we are reassuring customers, particularly in times now of high inflation, that on a particular number of items, up to 2,000 in the last campaign that we did, that we will guarantee to customers that those prices are not going to rise for a certain number of weeks. So that gives customers reassurance. And then we've been making some really targeted investment in items that really matter most to customers. So particularly on fresh foods, so produce, so i.e. fruit and veg, and meat, fish and poultry. And that's paid off really well in terms of the volume response we've seen from customers. But also what we know is that if customers are buying those items with us in store, it means that they are likely to shop the wider basket. And so that's been a really important focus for us. And we've also been reassuring customers with Sainsbury's Quality Aldi Price Match. Again, this is not about having a huge number of items where we match versus Aldi, but it's about matching on items that really, really matter. So again, a big focus on fresh foods. And we again are delivering very good volumes in those, but also what we're seeing is a really good response from what we call secondary customers. So people who historically have spent less of their overall grocery basket with us because they've not trusted us on price across the whole range. We're starting to see a really, well, not starting to see, but we've developed over the last 18 months a really good a kind of response from those customers shopping more widely in the store. And you can see that focus on price, excuse me, very clearly from this external metric on the left-hand side. So this shows inflation on biggest 100 selling lines that grocery stores do. So this is from Nielsen, so it's external data. And you can see the Sainsbury's is the orange line there. So you can see that we were consistently deflating over the most of 2001 and actually continue to show deflation on those core lines, even at a period where most of the market has been gradually inflating more and more. So right now, yes, we are passing on cost price increases in a large number of areas where we really need to, where pressures on the oil price, on fertilizer costs, on huge numbers of elements of the supply chain mean that we are passing on price increases. But what we're determined to do, and what we have been really successful doing, is making sure that we are staying in a very, very good price position compared to our competitors. And you can see that consistency across that left-hand chart. And the point I was talking about with secondary customers shows on the right-hand side. So you can see where we are delivering better growth from secondary customers. But it's not just about price. And Sainsbury's has a fantastic reputation for quality and for range and for the type of products that we sell. And again, one of our key objectives was making sure that we were delivering on that better and delivering more innovations and more new and interesting products to customers. And we've delivered on that again in the first full year of the programme. So we've more than tripled the number of new products that we've introduced over the last year. And you can see that customers are recognising that in terms of the customer satisfaction and quality of items. Taste the Difference is a key part of that. So our private label premium products, where we've seen very big growth in terms of sales and the number of new lines. And that's something we will continue with, because as much as we know right now, there's a large proportion of customers who will clearly be watching the pennies very closely and seeking to kind of restrict their basket. We also know that customers will be trading down from eating out of the home. They'll be looking to eat high quality food when they are eating in home. And so Taste the Difference is a really important element for people trading down there. And even within the basket, we do see people who are saving money on the basics and spending a bit more money on the products that really matter most to them. And Inspire to Cook reflects the fact that we have seen post-pandemic more people scratch cooking. And I think that's because people were given more time during the pandemic. And it really lends itself to a business like ours, where we do have a wider range of ingredients, and this is something that we've expanded through this Inspire to Cook range. And online, excuse me, excuse me. Online, what you can see here with the bold line in purple is the number of weekly orders with online. So we went from just over 300,000 average orders per week online pre-pandemic. We peaked at around about 850,000 early in 2022. During the lockdown periods where demand for online was greatest, a fantastic improvement, increase in capacity from our point of view, and very profitable as well, because we were able to do that really from our existing infrastructure because we pick from stores. You've seen normalization since then as more people have been able and willing to get back and out into stores. We've been very pleased with the number of customers who have stopped shopping with us online, but we can then track, and they are converting to us in store quite often for the first time. So it's been a really good way for us to win customers. And we're now settling down at a lower level of online orders. But clearly, again, if you look versus the pandemic, for us, that means around about 15% of grocery sales online. Pre-pandemic, it was 7 or 8. And that's something we do expect to grow steadily from here. And it's a real point of competitive advantage where we have won a lot more market share in online over this period than our competitors, a number of whom have gone backwards. So it's a really important part of our proposition ongoing. Looking to Nectar, Nectar is increasingly a digital proposition where customers are accessing, firstly, all of the value that we deliver to them for their loyalty online, but also what we're delivering now is personalised value. So we are offering customers offers on Nectar that are individual to them. So we recognise what customers buy, what they don't buy, the kind of offers they're likely to respond to. And so customers are giving a personalised batch of offers every week. At the moment, that's in kind of relatively soft launch, just with the ability to use that through Smart Shop, through the in-hole scanners. Over time, that will become a bigger proposition and very, very important, because what it enables us to do is, rather than delivering value in the widest sense to a very wide kind of base of customers, it means we can deliver value really meaningfully to each customer in the way that means the most to them. And so it's efficient for us because it means that we can target investment at customers who are most likely to respond to it. And also for customers, it's most efficient for them because rather than because all of the value that we will be delivering to them incrementally will come on items that really matter to them. Excuse me. And then general merchandise and clothing. So this is a complex story for us, but ultimately we've built a structurally more profitable business. So recognising the fact that Argos was not delivering enough profit when we started this process, we've reduced costs significantly, primarily through the reduction of the Argos store base and hence a much lower rent payments, rent and rates values that we pay out every year, but also becoming more efficient in terms of the supply chain. Sales are lower as well because we've also focused, as I said earlier, on more profitable sales. So, far less driven by promotions and less driven by categories where margins are relatively thin. So overall, slightly lower sales, but a far better profit outcome overall. And cost savings, really important. So we acknowledged again 18 months ago that we were too complex as a business, and we had a significant opportunity to reduce the complexity and to deliver some really big savings in areas like supply chain and logistics by taking a business which had built too much complexity and a lack of uniformity over time, and bringing that together. So we're running some really big programs. We're making some tough decisions on things like closing counters in stores, closing some cafes, and over time replacing them with a better proposition, and reducing headcount in the head office. So all of those are, we're again 1 year, 18 months into a really strong program on this, and it puts us in a very strong position relative to our competitors in terms of how much costs we're able to deliver. So we know this year that we face some very significant cost pressures, not least from things like energy and wage costs. But we do say that we can more than offset that with cost savings, and we think that we're probably one of very few retailers who will be able to do that this year. So it puts us in a strong position in terms of our ability to reinvest in the offer. And then plan for better. Excuse me, I talked about this earlier on, broadly bracketed in better for you, focused on health, better for the planet. So our focus on reducing carbon emissions, both within our business, but also the emissions of our suppliers, which is a big program that we're now well underway with. Reducing food waste and reducing plastic, clearly really high priorities and where we have some very strong targets. And then not to ignore as well what we call better for everyone. So making sure that across our colleague base, across the communities where we operate, and across all of the businesses that we operate with, be it suppliers, be it third-party contractors, and that we're making sure that that we really have some important targets there to make sure that on areas like diversity, human rights, throughout all of our supply chain, we're delivering positively there. And then, and then on delivering for shareholders. So we're into a 3-year plan. You can see that we've got great progress in terms of market share, in terms of delivering value to customers and also to colleagues, where we've been able to deliver for colleagues. We've paid our colleagues in Sainsbury stores, we've increased pay by 25% over the last 4 years, increased it by 39% for Argos colleagues, but also delivering the cost savings to help underpin and drive some of that investment in the proposition and what we pay our colleagues. And we, again, are financially strengthened. We talked about that, talked about the balance sheet and the fact that that means that we'll be able to return more to shareholders over time. In terms of the year ahead, firstly, as I said earlier, some of that grocery demand will normalise this year. So some of that will drop back to normal levels. Operating cost inflation is a pressure, and we know that there will be pressures on disposable income for consumers. So they will be watching the pennies. But frankly, we're in a far, far stronger position to face into those things than we would have been 2 years ago. And we know that we're very well placed relative to our competitors. And hence, when we looked to the outlook this year, we are saying that we think the profits will be down year on year, but that we will still generate more than 500 million of free cash flow. And we were able to give that promise that we will deliver more of the profitability to shareholders in the form of dividends. So hopefully didn't take too long on that. I will now hand over to Q&A.
James, thank you very much for that presentation. I know you've been under the weather a little bit recently, so I really appreciate you being with us today and persevering through all of that. We are indeed going to take questions. And just a reminder to everyone, if you'd like to ask a question, please type it into the Q&A box at the bottom of your screen. If you see a question there that you like, you can upvote it. We've only got a couple of questions there, so hopefully we'll get through them all. But anyway, if you do see a question you like, you can click on the thumbs up button and we'll deal with that. We've had a couple of questions that have come in ahead of time. I'm actually going to start with those, and then I'll deal with the ones that have come through during the webinar. And we'll also give you a chance, if you're going to write a question, to put it in there. So, James, just starting off with a couple of questions that we've received already. And the first one is, do you have any plans to open overseas operations?
In short, no. I think primarily as a grocery business, I think there are a number of years and a number of examples which basically show that there are very limited cross-border synergies in grocery. So principally, if you think about our biggest cost is the products that we buy, and those tend to be bought on a pretty localized basis, particularly if you think about fresh foods. So in general, there are very few examples of grocery retailers getting any synergies from cross-border operations. So I don't think that is ever likely to be a focus for us.
Okay, thank you. That's all. I guess quite conveniently goes on to the next question, which one came in ahead of time and one we've received during the webinar, which is what will your store footprint look like in 3 to 5 years? And then there's been, I guess, a specific question saying, I've noticed that our Sainsbury's local store has been closed recently. Is this going to be an ongoing policy? So maybe you could comment about store closures more generally, and also alongside the store footprint.
Yeah, so so in terms of the store footprint, if you look at the last couple of years, I mean, it clearly depends. And what I'll talk about here is I assume that most of what people are asking about is the grocery stores. And as I said, we've got about 600 supermarkets, so big stores generally out of town, and around about 800 convenience stores. If you look at the recent years, that number of supermarkets has broadly remained static, where we have been selectively adding a small number of stores every year, but also closing a couple of stores. And what that reflects is the fact that people are changing the way that they shop. So, so if you consider the market, or even for us, going from 7% online to 15-16% online, clearly that's going to put some pressure on some stores in terms of how much sales or the level of sales that's going through the front of the store. So, so I think that is likely to continue. So we will still open some new stores in areas where we have really good opportunities, but you might still see some small number of closures. But remember that as online builds, we are largely servicing this. Sorry, we were entirely servicing this from our store base. We don't have any big standalone warehouses. We're not investing in kind of incremental space there. So I don't think you'll see a dramatic change in the number of our supermarkets. From a convenience point of view, we are increasing the number of stores, but there is also, and we've hit upon a format that works really well, which is a slightly bigger convenience store that we call a neighbourhood market, which tends to be bigger than the normal 3,000 square feet. So a small supermarket in a small town, and the more of those such we could find, the better. But there is always more churn in the convenience stores. So thinking specifically about the question on the local store that closed, I clearly don't know which store that is. So we do close a reasonable number of local stores every year, and that reflects the fact that the convenience market tends to be faster moving. So so depending on whether how the kind of the town is developing or how the competition is developing, it's quite often the case that a site that had worked historically might not work. So we tend to have more flexibility and more churn in the convenience estate.
Okay, thank you. And a question here on inflation. What is the inflationary impact on margins and volumes, and are you an overall beneficiary of higher inflation?
Yeah, it's a really, really tricky question to answer, actually. So again, thinking purely about the grocery business and the high inflation that we're experiencing already, and likely to experience for some time, I think the market's sufficiently competitive that it is not just a kind of bonanza where it all kind of feeds through to the to the top line and then goes straight down to the bottom line. So generally the market tends to adjust in terms of the kind of percentage margin that's made. But really importantly as well, think about the volume impact of that. What's really important is that you make sure that you do everything you can to restrict the price rises you pass on to your customers. So we work really hard with suppliers to make sure that we're taking as much out of their supply chain as we can. And we push back on some of the big branded suppliers, because otherwise you will see a negative impact on volumes. So that's the long answer. The short answer is that we think that this year, independent of what might happen in terms of the COVID normalisation, we would expect grocery sales to be kind of flat to small up, and margins wise, we're anticipating margins not showing a significant change year on year.
Okay, thank you. Got a question come in during the webinar that's linked to that. Can you tell us a bit about the scope for further efficiency savings within the online packing and delivery? And are there any particular initiatives you're looking at?
Yeah, so online has become a significantly more a profitable business, and the main driver of that has been the bigger volumes we're putting through a relatively limited number of store operations. So of those 600 stores, supermarkets that I talked about earlier, we actually deliver online from less than half of those. So we're consolidating all of that growth in a smaller number of operations, and that's very efficient for us. In terms of how we make it more efficient, really the large area of cost where we can become more efficient is labour cost. And so picking in stores, there are constant improvements to the technology that we're using. So I think quite often that there is a view that it's really inefficient because effectively our online shoppers are shopping in the way that perhaps you would if you were to go to a supermarket. Nothing could be further from the truth. So it's an incredibly sophisticated program driven by algorithms where we consolidate all of the orders. The pickers are picking a very small part of the store very efficiently, and then consolidating orders in the back of the store. And just small changes to that can take quite a significant amount of cost out of the picking operation. And then this year and then obviously the second big area of cost is in the driving and the delivery and the costs of people being out on the road. And we're delivering a step change this year actually in terms of the way that we route orders and the way we consolidate orders between different stores and localities. So all of those things, it never sounds like any kind of big incremental change, but all the time there's small changes which are taking cost out of that operation.
Yeah, I'll add a quick question from me here because it just came to me. Are you part of any of the trials about testing drone deliveries?
No, we're not at the moment. But I think at the moment, the way that online grocery operates predominantly for a business like ours tends to be very big baskets, so average of nearly £100, very different to in-store, which would be closer to £20 on average. And so the way the online market works at the moment actually really lends itself to a big consolidated operation, van deliveries. If and when the market goes more and more towards in-day delivery, smaller baskets, people expecting to be able to order and get something within an hour, 2 hours, the same afternoon, then it opens up a whole raft of opportunities for delivering different ways and kind of operating efficiently in other ways. As it is at the moment, that big consolidated operation works best. Okay,
thank you. Has the change in ownership of Morrisons and Asda changed the competitive landscape? Is Sainsbury's now a potential target for those that missed out on the Asda and Morrisons takeovers?
Sure. So again, if you consider back to that chart that I showed earlier on inflation over the last 18 months or so, one notable feature of that is that historically you would have seen Asda and Morrisons perhaps being at the keener end of the market, so least likely to pass on inflation, absolutely making sure that they are sharpest in the market. That's not been the case since we've seen both of those businesses go into private ownership. So I do think that and in both cases they are underperforming the market quite significantly in terms of their market share performance. So it has opened up an opportunity, I think, for stronger competitors to take some share from them, and that's clearly quite helpful. So at the moment, you've got a market where ourselves and Tesco are doing relatively well, and Morrisons and Asda are struggling of the historically quoted operators. In terms of whether that means that we are the next target, if you like, of private equity capital, I mean, you can't really sort of say anything other than speculate, albeit that given the where we are in the interest rate cycle, there is less cash, washing around, with kind of otherwise low returns. So I think that perhaps, if there was a frenzied view that was very likely at some stage, I think that's probably calmed down a little at the moment.
Okay, thank you. Back to online again. Is online dilutive to operating profit margins? And if so, why push market share? Or is there a cash margin and or social benefit from online?
Yeah, so it's a good question. So yes, it is dilutive. So if you take a kind of pure like-for-like comparison, and if you were to get in your car, go to a store, do £100 shop and walk out, versus us delivering £100 online basket to you, you coming to store is more profitable for us. But you then need to consider that given the market is moving more and more online, and given that those £100 baskets are really valuable to grocers like ours, then we think that that's really important, that we are in the market there. So we don't push, we don't really spend a great deal of money seeking to acquire people online, but we are really keen to make sure that we are good at online, because once you have a customer online, they tend to be far, far more loyal. People become very accustomed to which store they trade with. They have all of their favourites set up on the website, etc. And so that's a really good reason for why we're focused on delivering as good a service as we possibly can there.
Okay, I'm going to go back now to inflation and the cost of living crisis. Will you be more insulated from the cost of living crisis, given that your shoppers are more middle class and less likely to be squeezed by rising heating and petrol costs?
At the margin, yes. But at the end of the day, we can't. You can't be a business of the scale that we are, with 21 billion of sales, and not be a broad church. So our customer base, yes, we are more exposed to the south, more exposed to the southeast. We have a brand mix, a brand reputation, and a kind of product mix, which means that we do lean into more affluent customers. But to those charts we showed earlier on secondary customers, it's really important that you look to customers all the way across the piece. But yeah, we would hope we would get a little bit of insulation just from that geographic exposure to more wealthy consumers. And then second, one of the key questions for the industry now is, if we accept that post-pandemic we're never quite getting back to the way that we used to live before, and particularly that people will not be spending, necessarily 5 days a week in an office, where they did historically, then again, with the south and southeast being a little bit more office exposed, we do think that we are likely to have a little bit more of that lasting benefit of changing consumer behaviour than the average across the market.
Okay, thank you. Question here on the Sainsbury's cafe closures. In some stores, the cafe is on a mezzanine floor, making it difficult to use that shop space. What are the plans to maximise the earnings potential of this floor space?
Yeah, so I think the easiest thing to say across property is it would make my life a lot easier if there was a one-size-fits-all solution, but there isn't. So I can't kind of definitively say, well, listen, with all our mezzanines, we are. Sorry, back on now. So we can't necessarily say that with all our stores that having a learning centre, for example, we have third-party learning centres in some stores. In some places, it might make sense for that to become office space. But suffice it to say that the level of, again, reflecting the quality of our store portfolio and reflecting the south and southeast bias, where we are freeing up space, we find it very easy to use that space. If, to your point, if it doesn't work for our retail proposition, we do find that the level of footfall and the position means that we are very attractive to third-party operators.
Thank you. I'm going to ask this next question in two parts, because I think depending on your answer, the next part might not be relevant. So the first part is, do you have any stores in Northern Ireland?
Yes, we do.
Okay, so the next part is relevant. Are you experiencing difficulties under the protocol, and what do you think is the best way forward?
Yes, so it's less difficult now than it was when the arrangements were first put in place. we had to take pretty radical steps in terms of using a third party to actually manage some of what we were delivering into our Northern Irish stores, which was not ideal, A, because it cost us more, and B, because we were not able to deliver as good a range to customers. I'm not going to say what I think is the right solution. I don't think it's necessarily my job to say that, but suffice to say that we are very heavily involved in conversations with government. We've made it very clear that it's suboptimal for customers in particular in terms of firstly the offer that we are able to offer to them, and that's the case across all of our competition, and second, if we thought that this was going to persist, then we and others, I think, would question how many stores we would it would make sense to keep operating over time, and that clearly is not a great outcome for Northern Irish customers.
Thank you for that, James. I tried some meat-free burgers the other day, Beyond Meat, which are incredibly tasty. I hadn't had them before, but they were great. And this question's about this topic. Can you tell us a bit about the work you're doing on your meat-free but meat-like products? How do you work with manufacturers? Do you have your own range? Do you decide which manufacturers and products to stock?
Yeah, we do. So it's a huge area of focus right now. So around about 10% of the protein that we sell, so i.e. what you would count as a if you like an otherwise meat or fish type choice, it is already coming from plant-based choices. So that will be across areas like dairy and meat, fish and poultry. So and that's increasing pretty significantly. And yeah, own brand is a very large part of this. So own brand is heavily dominant in fresh foods anyway. So we are working really hard with our private label suppliers to make sure that that we're delivering a lot of innovation there. And if we think about the chiller, so again, if you're looking to help people make different choices, a lot of the time it's saying, well, here's a burger and here's a to your point, a kind of Beyond Burger, a kind of meat alternative, a kind of plant-based alternative, having those alongside each other, and we've actually increased the amount of space that we allocate to those alternatives by 40%. So it's a really big focus for us. Not just because we are targeting to increase that as part of our health initiatives, but also because customers are really demanding it. So for us, it's about making it as easy for customers as possible, and also making sure that we can do that economically for customers.
Okay, thank you, James. I've got the last question here, which is, why do you think Sainsbury's has been outperforming Tesco on like-for-like sales?
So we actually, on headline like-for-like sales, we haven't in the last 18 months or so. And the main reason for that is over that kind of shorter period, Argos has shown sales down year on year. So at our headline group like-for-like level, that means that we've actually underperforming on headline like-for-like. However, and it's a nice way to get into the question, on a truly comparable basis, on grocery alone, if you look at those volume market share statistics we show, and if you look at what Tesco discloses on grocery, for example, then we know that we have been outperforming Tesco. What's been the main driver on that? We think we've been making more progress on value. So we said that we weren't in a great place on that a couple of years ago. So we've been showing more progress on value, showing more progress on innovation, and also pretty consistently delivering on customer service. So you get all three of those right, and customers typically will reward you.
James, thank you very much for answering all those questions. That conveniently brings us to the end of the questions and also to the end of the time we have available for today's webinar. I want to thank you for presenting and thank you for turning up at this ShareSoc and Yellowstone event. A reminder to people that the presentation recording will be available on the websites afterwards. We really appreciate your feedback. So as you leave, if you could complete the feedback form, that would be very much appreciated. And just to flag up some events we've got coming up in June, Poolbeg Pharma on the 9th, Castings and Oxford Biodynamics on the 21st, and Halma on the 12th. And details of those events are either on the Yellowstone Advisory events page or ShareSoc events page. Last thing to do is just to say thanks again for Sainsbury's and James Collins for presenting today, and we hope to see you all soon. Thank you very much.